Charles, so wonderful to have you here today for this interview. As you know, I'm a big supporter of the ADA gang. We'll talk about that here in a little bit, but I thought first I would share a story with you.
Mm-hmm.
Okay. So I went to Bitcoin 2020. This was 2 years ago. And I went to the airport. I landed in Miami, and a young lady walked up to me, and she said, "Oh my gosh, I'm such a big supporter of yours." And I said, "Okay, that's cool. You know, I'm glad you watch the channel." And she said, "Well, you're Charles Hoskinson, right?" And I said, "No," but she didn't take that for an answer. She thought I was kidding. And so she said, "Did you talk to me about how her and her dad in South America, they set up a Cardano staking pool and how they were doing really well with it?" And so I ended it with telling her, "Thank you for supporting my project." So what message do you have for that girl today?
Well, I'd love for her to reach out to me over Twitter. We'll see where she's at. But it's amazing. I mean, we had back in 2020, there was the ITN, the incentivized testnet, and we created a whole bunch of pioneers as an ecosystem. And those 1,000 stake pools rolled over. Now we have over 3,000 stake pool operators, and it's one of the most decentralized networks in the entire cryptocurrency space. And a lot of these stake pools go beyond just a profitable business. What they do is they have mission-oriented pools. So we see a lot of people who are feeding homeless or kids, or doing clean drinking water, or providing electrification for people who don't have it in Africa. So it's really amazing to see that diversity of commercialization meets mission orientation. And almost all of them are small business owners. So there's thousands of small businesses that have been put in business by Cardano for the business of running the network. And it's truly amazing to see how that's happened, and to do it in a very green way as well. So these stake pool operators, the amount of energy consumption per stake pool is usually less than what it takes to run your Tesla car, or a small house or something like that. And in aggregate, the power of this hotel that we're in is probably the whole Cardano network. Yeah. Contrast that with the proof of work world, where it's the energy of a nation state. So it's really amazing to see what science has been able to do, and good protocol design. It brings people together, it creates economic opportunities, it gets more decentralized over time, and it's environmentally friendly. That's a winner for me.
Yeah, well, definitely that's got to be these days. If it's not, if Bitcoin launched today, I don't think there's any way it would be able to work, because the people that are, for the climate and against climate change and all that, they'd fight back against it so hard, but now it's so far in development. Interesting story. I just got lots of stories for you today, Charles.
Okay.
So
it's story time.
Story time.
There we go.
So we recently did a video that'll be out by the time this video airs, where we went to CleanSpark, which is in the Atlanta area. It's a mining facility, and they actually started as an environmental solutions company. And they found, through researching all of the FUD about Bitcoin and the environment, that actually Bitcoin is, could be one way that we solve a lot of the environmental issues and create the more renewable energy sources. But so it's very interesting, but obviously Cardano already has that built in with the environmentally friendly angle of it. So in terms of the network, a question that I had for you is, right now it's in megabytes, the total amount of space on the network. Do you think that ever has to change to go to a higher level? Like when the Cardano network is in full capacity, like what kind of energy do you think it's going to take?
Okay, well, we're talking about storage versus energy. So first, with respect to storage, you have a situation where if you have a system that continues to grow, eventually you're going to have not just megabytes and gigabytes, but terabytes and exabytes and yottabytes and
yottabytes.
Yeah, yotta is like as big as it gets.
Oh my gosh! Wow.
Like the NSA storage facility in Bluffdale, Utah, is about 4 yottabytes. It's just massive amounts of data. You need a 50 megawatt power plant to run that data center. It's crazy. So that'll eventually happen if you're archiving everything and you want to preserve this concept of inclusive accountability and auditability and so forth. So one of the most important areas of research in the cryptocurrency space is the zero knowledge research lines, because there it gives you your cake and you get to eat it too. So people are talking about saying, well, I want to have a light client, but I want to have a full node security. In other words, if you send me a transaction, I'm interacting with a smart contract, I'm doing something, you're able to verify that the things you look at are correct. Great. So that's one dimension of it. The other dimension is what are the operating parameters of the system? In other words, to do all of this stuff, how much energy is consumed? So we tend to think of energy strictly as a consensus business, but you're very apt to link energy to storage because it's also a situation of, well, you have to all these hard disks and all these other things. So if you have talk about a yottabyte of scale, the NSA is burning 50 megawatts for their facility. So you'd be basically a power plant to store all this stuff, and that's just in a distributed sense. If it's replicated, it'll be even more. So there are some interesting questions about how do you amortize that and how do you incentivize that. And we published a paper not too long ago called Minotaur. And this is part of the future Ouroboros agenda for Ouroboros Omega. But Minotaur is basically a multi-resource consensus model. So we tend to think of, well, proof of work versus proof of stake versus proof of storage versus proof of history. Well, what if you could just do all of them in one network? So one cryptocurrency has multiple consensus algorithms, and they're weighted against each other in some way. And then as a result, you're incentivizing now the development of different resources that the network can use. So some of those are, the proof of stake is really good about decision making. It's really good about voting. It's really good about delegation of authority. Proof of work is really good about aggregating large amounts of computation. Well, proof of storage be really good about creating a network of storage places to put things. Well, if you had a master algorithm, in this case Minotaur, it would be able to do all of those things. And it's something that we've been exploring for the future Cardano agenda. So what happens post-Voltaire when you look at those things? So the next 5 years, because we looked at 2015 to 2020 for that horizon. And so we say, well, okay, 2025, 2027, this horizon, where do we go from there? And there's
the Cardano roadmap grows.
Exactly. And the point is that you want to be ever in solving not just problems that are today, but problems that are going to come 5 years or 10 years as a consequence of success. Ethereum ran into this where, okay, what happens if Ethereum gets adopted? Well, Ethereum gets adopted, so you have high gas fees and all these other problems. And they're like, boy, we should really solve that. So all these things came, some from the community like Polygon and rollups and these things, and others from Vitalik like Casper. But the problem is that the lead time was very, very long. So one of the things we tried to do was front load a lot of architecture and protocol design so that we're able to solve these problems faster as an ecosystem. So when you look at Ouroboros, for example, it's quite easy to imagine multi-resource consensus with an Ouroboros model. It's not a mammoth departure from the fundamental design of what we've done, so we can bring that to market much faster. When you look at zero-knowledge proofs and these things, it's much easier to do that with an extended UTXO model, the accounting model of Cardano and Plutus, than it would be with an account-style model. There's less to prove. The circuits are much simpler and these types of things. So that's kind of the great beauty and elegance of Cardano's design was there's a lot of future-proofing that's sitting inside of that, and that translates to better, faster, cheaper, and that translates to more responsible protocol design that ultimately doesn't burn out the environment or doesn't cause existential concerns long term.
Yeah, I think that's a lot. That's a big brain answer right there. There's so much
I said a lot there tonight.
Yeah, it was a lot, but I was trying to digest it. I mean, it's good stuff for sure. And I think the idea of looking further than the planned roadmap to the next 5 years, I think that's big. And when you look at Cardano, one thing that I really love about it is the ADA gang and the community. I'm really big on communities. And I guess the first question, very simply, is the ADA gang actually a gang?
I don't know where the term ADA gang came from. The Cardano community is huge. Like we had a community event here right before the consensus, and 1,200 plus people showed up for it, which is just extraordinary. And some people flew as far from Singapore and Australia. I can't imagine sitting on a plane with a mask on for 15 hours and coach. That's nuts. That's nuts. But they did, and they did just to be here and show support and to tell the world that it's a real movement, and there's millions of people in it now. Over 1,000 dApps are under construction. There's 5 million assets have been issued. If you look at for example, the NFT volume, about 40% of those 1,000 apps are NFT related. There's $270 million a month of transaction volume on NFTs in Cardano. We're like number 3. I didn't even know that until like a few weeks ago. They said, oh, by the way, and it's like, wow, I knew we had NFTs, but I had no idea that we had gotten that much progress. So the community is very passionate about these things. And what's so cool about it is they like working together and collaborating. Like I got a demo the other day from a dApp being built on Cardano called Cornucopias. And they're building a metaverse for Cardano. And I asked the origin stories. I said, how'd you guys all meet each other? And they said, well, one of them was in an early Catalyst fund, and another one was doing something else. And they saw me on a video say, hey, we need that. So they cold called each other, and they got together, and now there's 40 people in their company. They've raised $10 million, and they're building this big metaverse. And it's just serendipity of that. Well, there's hundreds of stories like that, where people spontaneously are popping up, working together and creating things. And every reasonable metric you can track is very strong in the Cardano community. And every time we've asked the community to do something like the incentivized testnet or the Plutus Pioneer program or DApp development, they've exceeded expectations. They've done some amazing things.
Yeah, well, we're excited about Cardano NFTs. We have a show, NFT Alpha, that's a separate channel, and they've discovered that the community is just rabid over these Cardano NFTs. We're actually putting together our own NFT platform, OpenSea competitor, mostly because I hate OpenSea. But we're
the only one.
Yeah, we're coming to play ball, and it's going to be real serious, and we're planning hopefully to launch with Cardano as one of our chains. So really excited about that. But when it comes to this idea of Ada Gang, this idea of the people's coin, I guess is a good way to say it. When you look at the distribution of the holders, it's much different than you see a lot of other places. And I would say it's basically the antithesis of what we've seen with Solana.
Yeah, it's not a VC coin by any sense. Or if you look at the Masari graphs, for example, of the distributions, there was no special carve out for some cadre of VCs or these things. And the market ultimately gets to decide that. I just always felt that you should launch it like Bitcoin or like Ethereum if you're going to build a real community that's sustainable and you don't have information asymmetries or insider commitments and promises that ultimately cause problems.
So when it comes to Solana and their outages that they've had, and you look at the disaster that's occurred with Terra Luna, what is it? Do you think it was a scientific approach that Cardano has taken that has led it to not have those same kinds of problems?
Well, Solana and Terra Luna are fundamentally different animals. In the case of Solana, that's a case of where they designed a protocol in isolation, and they're starting to learn that you need a more holistic approach. Solana, this proof of history thing, it's clear they didn't quite design the network stack at the same time. They viewed it as a commoditized asset. And so when you combine your network consensus together, what ends up happening is you have all these edge cases that cause the network to halt and have to be manually reset and so forth. And there's lovely papers. There's one David Shee wrote out of Stanford that talk about how perilous it can be with proof of stake style systems with attacks on the network stack, especially when you introduce like complex things like DAG protocols or these things into it. So it's just in a case study of where unexpected complexity and unexpected edge cases can cause issues, but they had a desire to be fast to market. So they said, oh, well, we can retroactively resolve those on the back end. And it's the market's decision whether to punish that or not. Yeah. And in some cases, the market doesn't at all. The greatest example of that in all of history in computing is probably the invention of JavaScript. There you had a massively deficient language that was built in like 2 months, and it became the lingua franca of the web, and they're like, oh, well, we'll fix it. And it took 15 years to completely clean up JavaScript to a point where it's a reasonable development experience. So Solana might actually be right in that respect, and it's a choice. Now, in the case of Terra Luna, that's an example of where you are doing complex financial engineering, and you're not understanding that certain edge cases result in the death of the system.
Yeah.
So
vulnerabilities, basically.
Yeah, well, it's a bank run.
Yeah.
And so, the very first cryptocurrency I worked on was BitShares, and we were way ahead of our time there. Dan Larimer and I.
I didn't know you worked with him.
Way back in the day. And I didn't work with him long. I was only there for 4 months. I took a buyout. And went
well, he's not anywhere long either, so.
Yeah. Well, anyway, yeah, Dan had a good idea with BitShares in that it was basically a DEX and an algorithmic stablecoin. And we looked at designs like partial collateralization. And there we said, well, there's these edge cases that come up, and when they come up, you have a bank run and the whole system dies, and you can't reset it. You can't restart it. It's done. So that's probably a pretty bad deal. Now, the temptation of partial collateralization is that you get the delta, and so you can have high yields, you can make great returns, and it's magic as long as it's working.
Yeah.
The design of BitShares, we used over-collateralization because we recognized that while that was tempting, the problem is that if you have a bank run, the whole system dies. So you can certainly do an algorithmic stablecoin. The problem is building an algorithmic stablecoin that is an attractive investment vehicle that has high yields that people in this industry seem to be addicted to is problematic at best.
And unsustainable.
It's unsustainable, yeah. And that's the challenge. So that's something that common sense would tell you. It's like, can you get 20% forever? I was like, no, it's not going to happen.
What's a decent percent? I say 6 to 8% may be reasonable.
Well, it just depends on macro factors. So first, you look at indexes like the S&P 500 or the traditional equity markets, and over 100 years, with Dow Jones or S&P, these other things, 7 to 9% on equity.
Okay.
And then you also have to look at your inflation rate. So what does percent mean? Well, if you have a large amount of monetary expansion, you have to get returns above inflation, even break even.
Yeah.
And so they say inflation's 8%, but it's probably more 15-20%.
Well, they changed it to the CPI. That's why you see the big drop in inflation over the years.
And it's a bunch of bullshit. It's like, well, inflation's not bad as long as you discount the price of fuel, beef, chicken, pork. Everybody's doing great with $7 a gallon gasoline. So, what do returns look like in those types of scenarios? It's the best you can do is break even or lose value every year. So, and also returns are connected to risk. And so if you're going to get 15-20%, the question you should be asking is less about how do I get 15-20%? It's what risk am I taking? Yeah. The problem with our industry is that risk tends to be hidden. So it's not transparent. So you think that you've quantified everything, but there are these edge cases that are buried under something. And if you're not really careful, you'll stumble on them at some point. And instead of losing 15%, you lose everything.
Yeah.
You get a 95% decline or 99% decline. It's just all gone. The other thing is that a lot of things are constructed in a way to restrict liquidity so that you can get these outsized returns, but then the insiders don't have the liquidity restrictions because of the way they've designed things, so they're the first to sell. Yep. We have a word for that. It's called Ponzi. And so that happens a lot in the industry as well. And this will naturally resolve itself over time through regulation and through investor education and these types of things. But in the short term, it's problematic because DeFi can be engineered in a way to amplify and exacerbate these types of problems. And Terra Luna is a great example of that, where it worked until it didn't. And while it was working, it made people fabulously wealthy on paper. The insiders may even had a chance to liquidate a little bit. Maybe they even got some tattoos, who knows? And then then eventually the whole system came collapsing down, and then everybody lost liquidity. And now we're looking at that. By the way, that's the same size as Bernie Madoff.
I know.
$45 billion. It's pretty crazy.
Yeah, it's not that much different than BitConnect either. I think BitConnect was about 4 billion, somewhere around there. One plus or one coin, I think, or plus token. One of those was, I think, 5 billion even. So, well, that's very interesting. I like to tell people all the time, in the DeFi summer, I got caught up in a lot of the DeFi stuff. And, I learned a very valuable lesson through yield farming, which is if you're making 20% on an asset that's depreciating by more than 20%, you're not actually making money. Yes.
And also that 20% has to come from somewhere.
Absolutely.
There has to be someone on the other side of the trade.
Yeah. So what about, so you guys, and I'm not 100% to be transparent with you here, how involved you and IOHK are involved in this, but Cardano has an algorithmic stablecoin coming to Djed, DJED. Are you guys involved in that?
So Djed is an interesting story. It's been my white whale to say, can you create an algorithmic stablecoin? Not because I care so much about how do we build a Tether competitor or a Circle competitor. It's just that I realized at some point nation states would start adopting cryptocurrencies as sovereign currencies. And this is what happened with El Salvador, and this is what it's now happened with Central African Republic. The problem is that while that's a great store of value, the issue is that it's not a good means of exchange or unit of account. There's too much volatility in it, and it's not a good transactional currency. So how do you have a bi-monetary policy where you have some unit that's your reserve currency, and that's where your value comes from, and they have another unit for transactions? We used to have this in the United States, gold-backed money. Right. The Bretton Woods Agreement. So we had a gold money, and then you had the actual dollar to transact.
Thanks, France, for coming over and trying to take your gold.
There you go. And so the thing is that we created Djed as a reference because we actually thought it would be really cool for nation states to use it. So people within IO, we wrote a white paper and did a lot of formal methods. And the idea is that we wanted to pull something like what Elon Musk did with Hyperloop. So he came up with the design, wrote a paper, and then gave it to the community and said, go build it. So other people can take that and deploy it. So I think one team is deploying it on Milkomeda and Solidity. And then another company, Cody, is taking that design, and they're going to be launching that as a stablecoin on Cardano. And what's exciting is that the marketplace of ideas will compete, and we'll see what happens. And what's nice is that we can learn if the specification makes sense or not. I think it's a very sensible way to do that and test it. But doing it at the protocol level is very dangerous, because if there's a design flaw, like in the case of Terra Luna, then the whole thing comes crashing down and collapses. If it's a dApp, it's just the TVL that's associated with that. So you kind of bulkheaded your risk.
It wouldn't bring the whole thing down.
Exactly. It wouldn't bring the whole thing down. It's a problem locally for the people involved in that, but that's the risk that they take. So what we did is we just wrote a reference and didn't make any money on it or anything. We just gave it away and said, all right, it's open source and it's a paper, and here's our best approximation of how an over-collateralized algorithmic stablecoin would look. And what's very exciting is it would be great to take that to nation states like the El Salvadors and Central African republics and say, hey guys, why don't you experiment with this to create an algorithmic stablecoin that's pegged to the dollar or the euro without having to have dollar reserves or euro reserves. Or you can come up with other different things. But it's part of a broader conversation of how do you create a financial system where one side has volatility but potential upside, and the other side has stability but no upside.
Right.
And so some parties need the stability, some parties are speculators and they'll take the risk in that respect. And that's really the conversation of algorithmic stablecoins at its core.